This earnings season has painted a bit of a muddy picture when it comes to the consumer. Walmart seeing strength in the high and middle class, while restaurants like McDonald's and Yum Brands warned about cracks in the lower end segment. Meanwhile, that consumer sentiment data last week also pointed to a slowdown, a sharp decline of 13 points month on month in May. But that's not stopped the Wall Street rally, with the Dow, as Dom pointed out, hitting 40,000 today. Joining me to make sense of it all, Charlie Bobrinskoy is vice chair and head of investment at Ariel Investments. Charlie, it's great to see you.
Thanks for having me, Kelly.
You surprised we're here, 40,000?
No. I'm glad you're focusing on the Dow, because the Dow is not driven by the Magnificent Seven in the way the S&P 500 is. The Dow is much more traditional industrial companies, a lot more value stocks. So when the Dow is doing well, that's the sign that it's not just a tech rally. And so we are seeing some of the names that we love, like Goldman Sachs, which is in the Dow, up 20%. We're seeing some of the building product stocks that we like a lot that are up significantly as well. So this is not just a tech rally, and that's why the Dow's doing so well, is so good.
Dow's even done better than you'd think, because if you go to total returns and not just price, I mean, it's interesting to actually sit back and think for a second that the Dow, the S&P 500, the NASDAQ, these are price indexes. So when stocks go ex-dividend, they drop in price, but you don't include the reinvested dividend in the index performance. So actually, if you go back and take from 1987 reinvested dividends, according to the S&P website, the Dow would be at 98,000. So I think we need to break out the Dow 100K hats here.
That's a great point. And you can typically add about 2.5% dividend yield to most price appreciations. That's not a bad estimate for what you would actually get. Now, of course, you got to be disciplined there and not pay taxes in the meantime and not pay a lot of commissions trading the stocks. But if you just held these names in a tax-exempt product, you're absolutely right. You'd have significantly higher than the published returns.
Yeah, it's extremely impressive. I mean, on a top level, what do you think is going on here? Because I sometimes do look at Japan a little bit and go, okay, the yen's collapsing, so the price index, or stock prices are doing okay, but the economy doesn't seem that great. And, they have high debt situations, similar thing we see here. Is there any way in which these gains might be some kind of phantom, or is it no, this is the genuine strength of the U.S. Corporate economy?
I think it is the latter. The earnings that have come out recently for first quarter earnings surprised to the upside. And that's in the face of the Fed obviously having produced an inverted yield curve, which is putting a lot of pressure on anybody, including consumers, that has debt. And so we are getting solid performance out of companies that are producing decent earnings. And again, for these Dow names, this isn't inflated PE expansion. In fact, we're seeing some very attractive EV, enterprise value to EBITDA multiples that have actually come down. So we have a measure that we use, which is value to private market value. Where are stocks trading compared to what we think they're intrinsically worth? And that number is actually not flashing warning signs. It's actually showing decent value.
Well, maybe it is. We were talking with James Demert about this yesterday, but maybe it is like the 90s all over again. And it's a productivity wave, and we're going to be just fine. I mean, maybe you can address that and also talk a little bit about why you expect to see this LBO wave coming, especially in an era of high interest rates.
Yeah, so let me take the second one first. So traditionally, private equity firms don't spend a lot of time looking at PE ratios. They look at enterprise value to EBITDA as the best measure of what they're paying for a company. And for many of the stocks that you and I talk about all the time, value names that haven't kept up with the market, that enterprise value to EBITDA ratio has been coming down to what are now attractive levels. So the building material companies, Mohawk Carpets and Residio, Honeywell Thermostats, those are now both less than 8 times. They're about 7.5 times EV to EBITDA. The auto names, Borg Warner and Phinia, which I love, are now trading at less than 6 times EBITDA. And the oil companies, Apache, which just continues to make a lot of money and is going to have a wonderful find off the shores of Suriname, is trading at less than 4 times EBITDA.
Wow.
So those numbers are starting to make a lot of sense for private equity firms who have raised a lot of money, and they've been sitting on it for the last year, and I think it's going to start to get spent in the next 6 months.
Right. I've been wondering what's going to happen to that entire sector in this era of higher rates, but maybe some of these valuations can bail them out. That's the last time we had that many exclamation points about valuation was the home builders a couple of years ago, and that would have been an amazing trade if you picked those up when they were at minus 4 times or under 4 times, for instance. So just final word, you have a little bit of caution on the consumer. What is that exactly? And what's your market kind of position for the next 6 months?
Yeah, thanks for calling that out, Kelly. This is a change. I think 2 or 3 months ago, I would have talked to strength throughout the consumer with a very good job market, higher wages. That's still true for the middle class and for upper income earners, but it's not true as much for some of the lower wage earners. And so we're seeing some pressure. We're seeing some caution, some price shopping that we weren't seeing before. A lot of this has to do with the Fed reducing the money supply. When the upper end of the economic curve is thinking about its wealth, it's not thinking about the cash they have in the checking account or the cash they have in their pocket. But if you're living day to day, paycheck to paycheck, you're worried about the cash that you have. And the Fed has been taking cash out of the economy. So we are no longer flush in that regard. And so the lower end consumer is under some pressure that they weren't on 2 months ago.
Does that make you just avoid consumer facing stocks, which I don't really hear you pounding the table on anyway? Or what's the investment thesis?
So no. So the homes and auto are still bought generally by the middle class and more affluent consumers. And frankly, those people are doing very well as the stock market hits highs. So we're very positive. That's why we're positive on housing and autos. And those stocks are so cheap that when we get the Fed cuts that we still think we're going to get this year, it's going to be much more financeable to buy a home or a car. And that's why we think those names can do quite well.
Interesting, contrarian. I don't know if I'd call it contrarian, maybe more on the auto side than I don't know. Charlie, thanks for joining us today. We'll get the hats for next time.